I would just recommend not thinking the stream of thoughts of how much down payment can I afford? Okay, that means I can afford this amount of home.
First, let's talk about how to get approved. Getting approved is primarily based on 3 factors, and that is your credit, your income, and your debts. In general, you want your credit score to be around a 620 or above to get the most benefits and options in terms of rate and loan products. You also want to make sure you have at least 3 trade lines or 3 lines of credit that are active and in good standing, and preferably that you've had at least 2 years. It's important to note not only do you want your accounts to be in good standing, but it's important that you haven't had any lates in the past year. Income. When it comes to income, you want to make sure that you have had at least 2 years of consecutive work history in the same industry or the same role or with the same employer. You want to be able to show the bank or the mortgage lender that you have a consistent line of work that is likely to continue for at least 3 years to come. For this, it's important to make sure you keep track of your W-2s. Most mortgage lenders are going to want at least your most recent 2 years of W-2s. Not your tax returns necessarily, but your W-2s. You want to make sure you keep these on hand, and if at all possible, you want to make sure that your income is not decreasing from 1 year to the next. This is a red flag in a mortgage lender's eyes, and they are forced to calculate your income in a way that is not as beneficial to you as if you had an increase in income from 1 year to the other. Always be working in your job towards making more or doing more hours or getting higher pay or getting a raise from year to year. This looks really good when you're trying to get approved. If you're self-employed or you're a contract worker and you receive non-taxed income, make sure to keep your deductions to a minimum because your income is going to be calculated based on your net profit after your deductions have been made. So if you make a lot of money but you've also made a ton of deductions, the amount of income that can be counted for approval is a very small amount. So you'll definitely want to consult a CPA at the end of the day, but don't take too many deductions on your tax return. You'll probably have to pay more in taxes, but you'll have more income that you can count towards getting approved for a house.
Now, the second thing you should know is that usually when you see a property, you only see it during a certain time of day. Maybe it's after work, maybe it's on a weekend or Sunday afternoon. You've only seen it during a specific time period. But it's very important to see the home at different times throughout the day and the night, because what could otherwise be a pretty quiet residential street could be a gridlock of traffic if Waze decides, hey, there's a good shortcut through here. Let's direct all of the traffic around this really busy street through this quiet area. And I see this happen all the time throughout LA. I'll be on a really busy street and Waze decides, hey, make a right on Bristol Court. And we take this all the way up, and it's a quiet street, and meanwhile there are like hundreds of cars pouring through. This is definitely something to consider. And I've also seen it on less busy streets too. For instance, here in LA we have Benedict and Coldwater Canyon, which are usually during the afternoon completely open. But as everyone gets off work between 4 and 7 p.m., it becomes a gridlock of traffic as people use these streets to avoid the freeways. So this is why it's so important that you see the streets at different times of the day just to know what you're getting into. Now I have a good story about this from an older buyer from about a year ago who opened escrow on a home near the beach with another real estate agent. Now the buyer made the decision to drive around the area several times throughout the day just to see what the area was like at different times. She ended up driving by the area on a Thursday evening and found all of a sudden the entire street was filled with cars, and there was valet running up and down the street trying to park the cars. Apparently one of the cars was blocking a neighbor's driveway, and the neighbor came out of the home and it was yelling at the valet to move the car because he was late for a dinner. Well, what ended up happening was that my buyer pulled over and talked to the neighbor of the house she was about to buy and asked, what's going on? How often does this happen? She found out that there was a country club down the street who ended up using that street twice a week every time they had events at the country club, and that this was a regular occurrence. She wouldn't have known about this unless she was driving around the area during different times. And because of this, she determined that that was a deal breaker for her. She didn't want to have to deal with that twice a week, and she canceled escrow. And then ended up using me a few months later to buy something at $2.4 million. But the moral of the story here is to drive around the area you're considering buying just to see if there are any hidden issues you might not be initially noticing.
Now, when it comes to applying for a mortgage, when it comes to getting your finance in order, there are some other things you need to really be considering. Number one, your credit score matters. Anybody telling you out here that credit score doesn't matter? They are a liar. Credit score really matters. How you've been spending your money, wild, it can come back to bite you in the butt. Now, if you guys want me to do a video on how to improve your credit score, caress the like button and I will do a video on it. But yes, it's really important. Number two, don't change jobs before you get a mortgage, or at least make sure you're working in that career for at least 3 months. When you do a mortgage application, they are looking for this kind of information. Where have you been working? What's the evidence? What your salary has been? If you've only been working at your new job for 1 month and you've only got one evidence of you being paid that salary, it's not going to be enough that you can actually keep paying going forward. So ideally, you don't want to be changing jobs before you apply for a mortgage. I've got to be honest with you, if you've got a lot of debt in your past or that you're dealing with or you're paying towards, it's not going to be helpful from a financial perspective for yourself, because you've got to pay for your mortgage and all this debt. But also, mortgage providers are going to be look at how much you can actually afford your mortgage and what are your other liabilities. Debt is a liability on your name that you kind of don't want to have, and it will impact a mortgage application. And this is a positive note. If you have someone that you trust, someone who you know is financially smart, but it could be an aunt or an uncle or a parent or a sibling or a friend that you have a good relationship with, if two of you guys can combine income to get an investment and also put a decent contract together between the two of you, then it could really help you, one, from having a large deposit, but two incomes are better than one on a mortgage application. So these are some of the ways that you can get your finances together to get on the property ladder.
So let me give you a couple things you need to do. If you're thinking about buying a house, and I want you to own real estate, owning a home and paying it off is one of the data points of an everyday millionaire. So we want you to do that, but we don't want the house to own you. So here's your rule of thumb, okay? Number one, you don't buy a house unless you're out of debt and you have your emergency fund. Now, everybody's going to tell you need to run buy a house, but everybody's broke, and you don't want to listen to them. It's not a popular thing to move a little slower with more maturity and more wisdom, but who gives a crap? This is not a popularity contest. This is you, your family, trying to build wealth and build stability and sustainability. Don't buy a house until you're debt-free and you have your emergency fund, and then you save up your down payment. And that's what we do. Ding, ding, just like that. And then when you do buy a house, I love the 100% down plan. I love it when I talk to a young couple. These killer millennials that I get to talk to, they're incredible. And they say, we got married, we were 23 years old, and we lived in a garage apartment, and we were making $110,000 a year, and we saved $50,000 a year for 4 years, and we were 28, we paid cash for a $200,000 house. I love the 100% down plan. And people are doing it, by the way. I recommend that. But if you're not going to do that, here's the most you should borrow. And it's the only thing I don't yell at you for borrowing, but I would prefer you didn't borrow, or that you borrow less, and get it paid off as soon as possible. But the most you should borrow is a home on a 15-year fixed rate where the payment is no more than a fourth of your take-home pay. So don't buy a home until you're debt-free, have your emergency fund plus a down payment, and on a 15-year fixed rate where the payment's no more than a fourth of your take-home pay. And when you pick a real estate, do not do real estate DIY. This is not DIY, okay? This is a $200,000, $300,000, $150,000 transaction. You don't work on your car, and that's a $1,000 transaction. You don't open up the back of your computer and try to fix that, and that's a $500 transaction. And yet you somehow think you're just going to waddle up and not get in a bad deal buying a house or selling a house. You make a mistake selling a $200,000 house. If you make a 10% mistake, that's $20,000. Think about that.
The next thing that
I didn't know was exactly what escrow is. I thought escrow was just a word that meant that time in between buying a house and getting the house, that time when you're closing. I thought that was just like the word for it, but that is not what escrow is. So escrow is actually, there are escrow companies, and the escrow company is the third party company that is dealing with all the documents, all the money, all that stuff, because you know, you can't just be sending those documents over to the home seller. Like, things would get so messy. So there's that third party, the escrow company. That's where you send the down payment money. That's where my monthly mortgage payment goes to them, because a mortgage payment is packaged up of, like, you know, your monthly property taxes, your principal, your interest, your insurance. So you give them all that money and they disperse it out where it needs to go. So I was so wrong in not knowing what escrow is. And when you go in to sign for everything, you go into the escrow office. I actually have it with me right here. So this is what it's like buying a house. This is the stack of papers that I signed on the day I went to the escrow office. That was another thing. I was so curious about the signing day, because you always hear people exaggerate, like, oh, you're gonna sign so much, your wrist is gonna be sore. And so I really didn't know what to expect at all. But basically what it is you show up to the escrow office, and honestly it takes about 45 minutes. There is a notary person there. You have to put your middle initial, which is something I didn't know. And I believe it was somewhere between 45 to 60 signatures. So it took about 45 minutes. So it was about a minute a page. The guy would basically like run through things. You'd sign. Sometimes you'd just initial. My wrist was not sore by the end of it, but it was a nice, fun, exciting thing to get to do, because it was like, I feel like I've heard about this all my life. What is it actually like?
First mistake that I made was when I was looking at homes to buy, I basically just decided to look for the price range that meant that I could at least put 20% down on a down payment. Yeah, that's a good thing, because for me it was financially wise. It would mean that I wouldn't have to pay private mortgage insurance, and so I would save money, plus I was putting more money down so I wouldn't have to take out as big of a loan. Pretty good advice in my own head. But the big problem there was that I wasn't considering what would happen after I actually purchased the home. I mean, you can have a huge pot of savings, but then your income that you make, you know, month to month may not be enough to cover the actual costs of the home as a whole. So even though I had saved a bunch of money, I wanted to put pretty much all of that money into my home, and then I didn't really consider the fact that my month-to-month salary might not be enough to cover my mortgage payments, my taxes, my maintenance, my homeowner's dues, everything else that comes into actually owning and operating a house. So yes, you totally want to have a goal, if you can, to put 20% down in a down payment on your home, but you also need to consider the ongoing costs that that means for you, and if that fits with your budget or with your salary. It also doesn't mean that you have to spend your entire savings on your home. You can consider buying a smaller home and then just spending less to put less down, just so you can make sure that you have an emergency savings already stashed away too. So to sum this up, I would just recommend not thinking the stream of thoughts of how much down payment can I afford? Okay, that means I can afford this amount of home.
The second thing on my list I wanted to share with you, even though it was something I did know because it has a lot of value, and that is to not maximize how much you qualify for. So the bank's gonna give you a loan for a certain amount of house based on your income and how much debt you have. And I'm so happy we kept this down as low as possible, because let me tell you, when they say you qualify for this much house, it is so easy to look at houses in that price range and start getting tempted and want to buy those homes. But like I mentioned in area number 1, there were so many premature expenses that I didn't expect in the upfront that I'm so glad I followed this rule. I really think if I didn't follow this rule, we would be so overwhelmed and stressed with this house financially. I think if we didn't follow this rule, I'd probably be fearful of losing this place or feeling like I'm just teetering on the edge of, if I lose my job or something bad happens, my husband goes to the hospital again, could we really afford it? So this was one of the most value-adding perspectives and actions that we took in this whole scenario. Thank God we did one thing right, that I'm really glad we knew and has added tremendous value to us.
Get 3 lender quotes. Do not just get one quote. I know what most people say is it's gonna hurt my credit. The FICO scoring model allows you to get multiple quotes within a short time period for the same financing type. So all mortgage lenders, when they pull your credit, they're pulling your credit under one finance type. Don't know what the number is, but say the number is 3. They're all putting in 3. So the FICO scoring model knows that you're applying for 3 different mortgages. So it only impacts your credit once. You can double check that. You can look at it. What I recommend is that you do it within 14 days. You'll find various things that might say 30 days, but 14 days is to be on the safe side. I would say do everything within 14 days. So verify that, but definitely get 3 quotes so then you know who's giving you the best rate and the best terms for your loan. Don't just go with the first quote that you're given and you have no idea if, could I've gotten a better interest rate or lower fees somewhere else.
The first mistake, and biggest by far, are those first-time home buyers going out and seeing properties without being financially qualified. This one is so important. And guys, I don't know if every first-time home buyer, they're all getting together and maybe like a meetup group and conspiring and saying, hey, let's not talk to lenders until we go out and see houses. But that is the wrong way to do it. You have to get pre-qualified, get financial qualification before you go out and see houses. Guys, you're setting yourself up to fail. Talk to a local lender beforehand. Get pre-qualified. Why? Why do we do this? Why is this important? Why do real estate agents tell you to do this? Well, you don't know what you can afford until you've been told what you can afford. There's going to be options in the home buying process where you can go this route or that route, but your budget and what you pay, that's not your choice. That's the lender's responsibility to come up with the numbers. There's going to be the slick websites out there. There's going to be the mortgage calculators online, and you might think you can afford something, but until you talk with a local lender and they tell you what you can afford, everything else is meaningless. All of that other stuff is absolutely meaningless. You may think you can afford a $600,000 house close to downtown, when in reality, you can only afford a $300,000 townhouse 30 minutes from downtown. So go out there, do your due diligence. Guys, I know you want to hit the pavement. I know it's exciting. I know you want to open up doors and go through and tour properties and you have your checklist. But the first thing, before we even get to your checklist of what you want in your house, is to go out there, get financially qualified, and talk with a local lender.